This question will walk through lessor accounting. Casa Leasing Corporation, which uses IFRS 16, signs a lease agreement on January 1st, 2020 to lease electronic equipment to King's Corporation, which also uses IFRS 16. The term of the non-cancelable lease is 2 years, and payments are required at the end of each year. The following information relates to this agreement. King's Corporation has the option to purchase the equipment for $13,000 upon the termination of the lease, and this option is reasonably certain to be exercised. The equipment has a cost and fair value of $135,000 to Casa Leasing Corporation. The useful economic life is 2 years with a residual of $13,000. King's Corporation is required to pay $5,000 each year to the lessor for insurance costs. Casa Leasing Corporation wants to earn a return of 10% on its investment. Collectability of the payments is reasonably predictable, and there are no important uncertainties surrounding costs that have not yet been incurred by the lessor. And we're asked to calculate the lease payment that Casa Leasing would require from King's Corporation. So knowing the inputs here, we've got what type of a lease payment would be required. So we're going to have, what do we know? So we've got the present value from the lessor's perspective is going to be the cost of the equipment. So what was the cost? It says the equipment has a cost and fair value of $135,000 to Casa Leasing. So we had to pay $135,000 to purchase the equipment. The interest rate is 10%, and we're told here, Casa Leasing Corporation wants to earn a return of 10%. So we're going to put 10% in as our required interest rate. The term of this lease is 2 years. And the payment is going to be, I think we're told the payment up here, which is that Casa Leasing, the payment actually is what we're calculating. So we don't know the payment, and the future value is going to be the residual value. So as the lessor, Casa Leasing, we know that we're going to get back either we know that we have a guaranteed residual value of $13,000. Even if we didn't, there was unguaranteed residual value, we would still include the $13,000 in our calculation. And we are going to have our begin mode on because it does state that the payments are due at the beginning of each period. So if we put all these inputs in and we say compute payment, we're going to get a payment of $71,595. And of course, that's excluding the executory costs. Next, we're asked, what classification will King's Corporation give to the lease? What classification will be given to the lease by Casa Leasing? So King's Corporation is the lessee. So the lessee classification. And we're using IFRS here. So from the lessee, all we need to know is this lease short term? 2 years, I would say no. And is it of low value? Payments of $71,000, $72K, no. So therefore, it is going to be a right of use asset. Those are the only way of getting out of the criteria. From the lessor perspective, Casa Leasing, we need to determine if this is a capital lease or an operating lease. And so we've got 3 criteria to do that. We're looking for a transfer of title. We're looking for the lease term being greater than 75% of the economic life, and the present value of the minimum payments greater than 90% of fair market value. So let's see if any of these criteria are met. So transfer of title, yes, met. We know that there is a guaranteed residual value, so that it's going to have a transfer of title. If the lease term is the majority of the life, so we know the lease is 2 years, what's the economic life of the equipment? The equipment has a cost and fair value. The useful life is 2 years, so it's a 2-year term. 2-year life equals 100%, so this is met. And the present value of the payments which is going to be the present value of the lease. So 71,595 compared to the fair value of the equipment. Is going to be, what's the fair market value of the equipment? The equipment has a cost and fair value of 135. So the cost of the equipment, cost to the lessor. So sorry, the fair value of the lease is 71 and the fair market value of the equipment is 135. So this divided by this is going to give us 53, so not met. But we've met enough of the criteria. We've met 2, so therefore this is a capital lease. Okay, so now we need to know what type of capital lease. So the cost of the equipment, was 135,000. And the fair market value is also 135,000. So there's 0 profit. Therefore, this is a financing lease. There's no profit on the equipment. And you can see that right here where it says the equipment has a cost and fair value of 135,000. Okay, so we've done A, B, and C. D says prepare a lease amortization schedule for Casa Leasing for the term of the lease. So let's do that. Let's prepare a lessor amortization schedule. So we're going to have date. We're going to have the annual payment. We're going to have the interest on the net investment. We're going to have the net investment recovery. And we're going to have the net investment. Okay, so let's just fix these. So our dates here are going to be, this lease was signed on January 1st, 2020. And let's just see here. January 1st, 2020. So we're going to put that date in here twice, as we always do. And then we're going to have 12/31/2020 and 12/31/2021. Actually do it this way, 1/1/2022. Okay. Okay. So at the beginning of the lease, we're going to record here our investment in the lease is the cost of the equipment. So we start the schedule off with 135,000, which is different. Normally we're starting this with the present value of the minimum lease payments when we're on the lessee side, but for the lessor now our net investment. So what have we invested into this so far? Well, we purchased the equipment, got 135,000. Now on day 1, remember there's not going to be any interest. So we need to watch for that. So all we're going to have here is our lease payment. We're going to receive our first payment, and our payments are going to be 71,595. And this is going to be the difference between the payment and the interest. And it's going to pull down the net investment in the lease. Okay. Actually, let's just take a look up here. You know what we've missed is there is a nuance with this question. So let's take a look. So Casa Leasing Corporation signs a lease agreement on January 1st. The term of the lease is 2 years and the payments are required at the end of the year. End of the year. So let's take a look and go through our calculations here and see what happens. So here where we calculate this, we don't want the begin mode on. So begin mode needs to be off. Because payments are due at the end of the year. We haven't seen a question where payments were due at the end of the year before. So the begin mode needs to be off and you're going to get the 71,595. You wouldn't have been able to calculate that before I clarified that we need the begin mode off. This idea that the lease payments are due at the end of the year is going to change quite a bit. So now our present value is 71,595. And when we run our lease amortization schedule, the lease is signed on January 1st, 2020. But now we're going to change it to say December 31st, 2020, December 31st, 2021, and December 31st, 2022. So 2021, it's only 2 years. So this is an entire year, and this is a year. So now we are going to have interest on this first period because it's an entire year. So we are going to have this amount is going to be the carrying value times the interest rate, which is 10%. Okay. This amount times 10%, I missed the percentage sign there, times 10%, okay, and that's going to bring that down, and then we can just simply have our second lease payment here, $71,595, and pull this down, okay. And we're going to have our guaranteed residual value here as well. You can see we've got our guaranteed residual value right here. So we're going to run our totals through this schedule. Okay, so we're going to run totals for the first 3 lines, and you can see this is the residual value. And let's take a look. Is that residual value guaranteed? Corporation, and this option is reasonably certain to be exercised. Okay. Okay, and actually, you know what? We should really be including that here. Let's do this instead. So we're going to have December 31st, 2021. We're going to have $13,000 as the guaranteed residual. And this is going to, we'll have 0 interest on that. And that will bring this down. So then we'll end up with a total net investment in the lease of, we've got our 135, and now our total payments are going to be 156. So the journal entry that we're going to have upon inception of the lease is going to be debit lease receivable, and it's going to be 156,190. And we're going to have credit equipment acquired for lessee, which is going to be 135,000. And we're going to have credit unearned interest income. And this is going to be the amount from our schedule here, this 21. Okay, and this is presuming that we had already recorded the entry to purchase the equipment. So let's do that. So purchase of the equipment. We're going to have debit equipment for lessee. $135,000, and then we're going to have credit cash. So now this entry simply is washing out that equipment acquired for lessee account. And then we've put the lease receivable in our books, which is the sum of all the payments under the lease, including the residual value payment, and the unearned interest income is all the interest we're going to earn over the lease. Okay, so that's the entry on the inception of the lease. Then we've got our December 31st, 2020 adjusting entries. So we're going to have one, which is going to be interest income, lease payment, and interest income. So we're going to have and because remember the lease payments are due at the end of the year. That's why we're going to receive it at December 31st. So we're going to have debit cash, and we're going to have, remember the lease payment isn't actually $71,595. it is $76,595 because there is a payment that's required to be made. Let's look up here. What's the cost for the executive payments? The King's Corporation is required to pay $5,000 each year to the lessor for insurance costs. So we added $5,000 to the lease payment. So basically, if you take this number and you add 5,000 to it, that's how we got this number. Then we're going to have, that's the cash because we're the lessor, so that's what we've received. Then we're going to have credit insurance expense because we have to just pay the insurance expense. That's why we got that extra 5,000. And the others we're going to credit our lease receivable. And this amount is going to be right from our schedule. Here we go. We're going to take it off of this, okay? And then we're going to record our interest income. So we're going to go debit unearned interest income, credit interest income. And this is going to be this amount from our schedule here. Whoops, where's our schedule? This is going to be this amount. And actually, sorry, we jumped a year. This amount and this amount. Same amount right off our schedule there. So we've got all the numbers that we need. And the amount for the next year, December 31st, 2021, we're going to do the same thing. We're going to have all these same entries, more or less. We'll just fix the amounts. So we're going to have debit cash. It's going to be the same amount. We're going to have the insurance expense. We're going to pull down our lease receivable by the same amount. And our unearned interest income is going to be this number this time. And same thing here. Okay. Let's see what else we've got in this question. So let's take a look. We've got assuming, so we did all the payments, assuming that King's Corporation exercises its option to purchase the equipment, prepare the journal entry to record the sale of the equipment. So we're going to have sale of the equipment. So we're going to have debit, lease receivable, because remember we had included the value of the equipment into the lease receivable for $13,000. And we're going to go credit lease receivable, and we're going to go credit. Okay, so our entry here is going to be debit cash and credit lease receivable because we had included that $13,000 in our lease receivable when we calculated it. So we need to clear that out in order for our lease receivable to be nil on our statement of financial position. Okay, so we've got that entry. Well, let's take a look at the question. What would King's Corporation capitalize and recognize as a lease liability and corresponding right of use asset on the signing of the lease? Okay, so up here we said that they would record a right of use asset, and the question's asking us what the right of use asset would be. So the lessee right of use asset. So we need to calculate the present value of the lease payments. So we're going to have N is 2. We're going to have I is 10. It's all the same inputs here as we used previously. Our payment we know is $71,595, of course, excluding the executory payments. And our future value is this residual that we owe at the end of the lease of $13,000. So if we go compute present value, of course, with begin mode on, begin mode off, because the payments are due at the end of the period. We are going to have a present value of $135,000. So they'll have a right of use asset and a lease liability of $135,000. And that takes us through the conclusion of this question. So the most important thing about this question is the fact that we signed a lease agreement on January 1st, 2020, but rather than the lease payments being due on January 1st, 2020, as we've seen in most of the other questions, we're specifically told that the payments are required at the end of the year. And so what that required is for us to do our present value or all of our financial calculator questions without begin mode on, because the payments are not due at the beginning of the year. They're required at the end of the year. And then when we did our journal entries, we didn't receive our lease payment on January 1st, like we often do. We needed to record the lease payment and the earning of interest income at December 31st. So really good question where it's important to watch for periods and make sure we really understand what it means when payments are due at the beginning of the period versus the end of the period, both for the calculations and also for the timing of the journal entries.